I want to talk about one of the big trends of 2023, and that was the covered call strategy. It started with JEPI a year and a half ago, but we had some record product launches in active management this year. But as I mentioned, much of it was for these covered call strategies. And those of you who don't know this, you own the S&P, for example, and then you essentially buy call options on it. So in my head, this is not really stock picking, old school active management. You're just doing an option overlay.
It's an insurance. Really is another way to
so why did that take off so much?
Well, I think, again, I'm proud of the ETF industry itself for coming out with these products and bring them to light. It's going to increase option flow, increases people understanding about trading, what they are. What it provides is, let's talk for the audience. In an up market, they're going to lag. So if we rally, these products will lag. They've had a good year because we've been in a neutral market in a lot of products. We've been in a down market in a lot of products. In a neutral market, they're going to outperform.
Because those options you're selling go in the money.
You're selling options out of the money and collecting the premium.
Yeah.
So it just adds.
But if the market goes up,
the market goes up, they're going to have to cost those, cover them at a higher cost, and you'll lose money. So up market, it underperforms. Neutral market, it stays kind of neutral. You get a little bit of alpha, but in a down market, it really overperforms. But and a great example. So you have the JEPI, right?
So it tells me that people want to buy some protection. That's what it tells me, essentially. I mean,
correct. The downside, you keep your exposure and you make a little bit of money.
Yeah. What I can't say is certainly, I think you raised some great points. But what I will say is, I mean, stepping back, I mean, we are seeing a large amount of product development. I think you kind of touched on a little bit. Record product development this year in the ETF industry. 80% plus was active. And then you have a big category, which is these option-based products, which have been a big story this year in terms of new launches. A lot of innovation there. We see a queue still forming, some of it public, some of it non-public. So we are going to see more products like this going into 2024 without a doubt. But it puts a bigger burden on investors and their advisors to really understand what's going on with these products. They are serving a purpose,
right,
but they are not all created equal. So it could be a difference in the underlying exposure or the type of protection that you're actually getting or the income that you're seeking. And I think it's very important to understand these differences.
I think the reason these things took off because of what happened in 2022. 20% down, and the S&P spooked a lot of people.
Correct.
And they wanted to get protection. These things are a sort of natural, I think of behavioral economics. This is sort of the response. Oh, I still want to stay in the market, but I got to protect myself from a 20% down year. I understand that.
You can look at the extreme example.
There's JEPQ, which is the NASDAQ version of the S&P.
Right, the Q. So it's a little bit more volatile. That would be the middle. I think that returned 11% so far this year. But if you look at something like KWEB, right, which is Chinese tech stocks, and then you have CLIP, which is the
so this Crane shares CLIP. This is a covered call version
on KWEB.
Of KWEB. KWEB holds China internet stocks,
now, to
Tencent and Alibaba, and then it does the same thing. It sells 1 month at the money call options on the full amount of the portfolio.
Correct. And the dividend is...
And these stocks have actually rallied this year, but look, there you go.
Yeah, the dividend is 4% a month. However, you're also down 40% on the stock.
Now, it should be noted that we are not including the dividend in that. That's a price, right?
Correct.
So
that's just the price.
See, that's part of the problem with these showing just the chart.
Yeah.
You should show total return on it. But the point is that it's down because of the performance of Chinese stocks.
Well, the underlying is Chinese tech stocks. So if you wanted to maintain exposure in that and you just weren't writing calls against it, it's a pretty brutal year, right? But you're probably flat to up if you're in CLIP because you're getting the dividend every month from selling calls, which we're never getting called.
Yeah, and again, folks, I want to warn you that is not indicative of your total performance that you saw. KLIP was down, and you really should.
And to Ben's point, you had to really look under the hood to see what asset class. But it's a very exciting product. All kinds of issuers, Simplified, Defiance, Innovator. They're all coming out with these products. Zega, which is a really traditional hedge fund, has these yield match products. They're doing synthetic longs in Tesla, and those are getting more attention than the single stock Tesla ETFs.
Yeah. So the hottest products this year were the short-term bond ETFs, the actively managed call strategies we just talked about. How about 2024? Let's spin this forward. Is this going to continue into 2024? This is the hard part, folks. It's really hard to figure out what the hot product's going to be next year. Any thoughts?
Well, look, I think I sort of alluded to at least one. I mean, certainly we are absolutely going to see more of these option-based products come to market. We see it in our own book. I can also tell you that without a doubt, there's going to be more attention paid to actively managed ETFs. We've kind of touched on this in a few different areas already. in this chat, but ultimately there's going to be more issuers that are continuing to chase this trend that we're seeing and that uptick in flows. And there is an expectation, at least at the asset managers. What happens in reality, we'll see. But the asset managers are looking at this as an opportunity at this point in the market cycle to try to pick up some of those flows, capture investor attention, and ideally outperform the market. So those products are going to continue to attract, again, a lot of attention from a marketing standpoint, and you're going to see a big percentage of the new launches certainly be actively managed.
Well, we talked about zero data expiration option ETFs a few months ago. That's 50% of the option volume right now. I have grave concerns about this. I don't mind professional investors playing same-day expiration options, but when you start dragging in the retail community, I get a little worried about it.
It'll be a similar education to the triple levered ETFs when they came out, and at least that lesson's been learned once. So hopefully that lesson will be learned.
We know. Come on, how many? I've been here 33 years at CNBC. The one thing I learned is there's always new people coming in who have to learn the same stupid things that everybody else knows already, but they have to learn it over again and make mistakes. That's what's depressing about the whole business of living in general.
I think we just had a Forex ETF launch, or ETN. So it's, again, you're just going to continue to see more of those products
thoughts
as
on
well.
2024?
I think where the trends are, I mean, obviously we don't trade any Bitcoin at Wallach Beth, but I think the spot ETF is going to garner a lot of attention. And at the very least, it will bring attention to ETFs. There'll be people that haven't traded an ETF before, where their first ETF will be one of these, spot ETFs. So that'll be very interesting. And then really, I think it's led by the market. If we get into a overall value market, you will see money come away from the covered calls because, of course, they'll underperform. But there'll be other option strategies like the synthetic longs, where the tickers are so high that they could start to get into those products. It just draws attention to alpha.
Right. That's the point. The ETF is a trend-following business, essentially. So if the market trends up, there'll be less interest in the covered call products and more in how do you leverage the market going up, right? How would you do that?
Well, I wouldn't suggest selling naked puts, so that would be the opposite trade.
The naked put.
And I don't think that's going to come out, and that's probably not a good idea. But they'll just tinker the strategy with the covered calls and how they rotate. They're all actively managed, which is a good thing.
See, this is part of the things I love about the ETF business and what I hate about it, because I love it because the ETF business is maturing now. So it's a business, and they're always looking for new ways to attract new people. And yet, at the same time, do we really want people going out buying naked put? I know you're joking, but that's not a crazy idea necessarily.
Probably not for some kind of way to cover it.
Not necessarily legal, but there's a way around it, what you're talking about.
Well, they're going to come
to Ben. That will happen.
They'll come to him with ideas for sure.
Yeah.
I just think it's generally going to be.
Are all the good ideas gone that aren't crazy?
4 years ago, you wouldn't have thought these covered calls might have been so big, and now they
laughed at it. You're right.
I think when you mention it as a business, as long as you're saying it as a business, don't forget the issuers are kind of, the bulk of their products are in these very low management fee products. This is giving them the opportunity to charge 75 bips, 100 bips, 80, and it's worth it, because if you're I'm not saying that it's not taking too much. If you're a retail investor trying to write your own covered call strategy on Schwab, with individual stocks, it's really hard to do.
All that money in short-term bonds and money markets, they're competition for dividend products. We've got plenty of dividend products that are equity products. How about any chance, Andrew, we get any inflows into normal equity dividend products, like the Spider dividend? And how about high yield?
I think you will. I think the high yield will continue because, again, the rates will at least level off in the money markets. And they're going to want to continue to get 5%. And the only way you're going to get that is equity dividends or high yield if you're going to go to fixed income. It'll go back to just the same trade we had 2-3 years ago. You'll get back. We've seen inflows into HYG and J&K and SJNK, those same names. And like I mentioned before, you have the dividend ETFs like the cows from Pacer, right? That'll produce a nice dividend. Again, we're going to have to get used to not getting 11, 12% anymore unless you're in one of these covered call products in the right market. But I think ETFs will offer. There'll be plenty of ETFs that will offer that equity, that will offer that 3 to 5% range. Of course, market risk, but the market should be rallying next year, I think. And then, of course, the high yield will kick into that kind of 6 to 8 range. But again, there's risk in those names. Right now, in your Goldman Sachs Marcus account, you're getting 5.25 with zero risk.